turning the video on.
Hi, everyone. Welcome. Thanks for joining us. We'll wait just a few moments and get started here very shortly. All right, let's get started.
I was going to say, it sounds like somebody else is on in our office.
Yeah, let's get started. And it's 2:01. We're going to start with a bit of housekeeping anyway. So those of you who are going to join a little bit later can go ahead and do so. Hi, Maria. Thanks for the little note. That's one of the housekeeping items is if you do have any questions, please go ahead and drop them into the chat field here at the bottom with Zoom. We do want to spend some time at the end answering any questions that any of you have. So please do put some questions in there. There will be a recording sent out after. This is going to be recorded and then dropped into an email. You'll probably get it tomorrow, but it will be available. So if you have to jump off before it's over, don't worry, we'll send you a note. Hey, Trinity. Yeah, so I think that's it for housekeeping. And let's go ahead and get started. We'll start with introducing ourselves. Obviously, we have kicked off this cash flow queries webinar series. Yep, that's a mouthful. Cash flow queries webinar series, really with the intention of just wanting to share and talk all things cash flow. And so it is going to be a series of webinars where one will build on top of the other, but starting with the very beginning one today called Cash Flow, Where Do I Start? So Kelvin and I will just maybe introduce ourselves. I'll let you start, and we'll start with introductions.
Sure. So just a little bit about who we are. My name's Kelvin. This is Twyla. We have our own accounting firm here in Calgary. I myself am a CFA, Chartered Financial Analyst. Lots of financial modeling, got a big extensive background in controller, CFO positions. Like to nerd out on Excel and forecasting. And so that kind of sets the stage for kind of where we're going here. Work with a ton of small businesses throughout my career and life. Love it. And just generally speaking, love to help people out. So I'm personally super excited about doing part of this and working together and helping talk about what we do as a firm and just people and thoughts that we have. And I really love learning about what other people do as well in this space. So really curious to kind of see how this evolves and grows. So.
Yeah, no, I think you've hit the nail on the head. I mean, we've got our own accounting firm called 2080 Financial. We've basically lived in this space ourselves. So, you know, cash flow forecasting has always been part of our practice. And so, you know, we started 2080 really about 5-ish years ago, and I've always been in that kind of what everyone's now terming as an advisor. We didn't call it an advisor when we first started it, but it was really kind of that advisory space. So cash flow forecasting has been a part of our service offering for clients for a number of years now.
Yeah.
Yeah, so, you know, really this particular webinar is going to start at ground zero. So, you know, if you are somebody who's already been doing cash flow forecasting, you will be finding that some of this might be a little bit elementary for where you're currently at, but we're doing that intentionally. We're doing it because not everybody has done cash flow forecasting in the past, or not everybody even has the same idea as to what cash flow forecasting is and what that all entails. And because we want to build off of each webinar one over the next, we wanted to just start at the beginning so that we're all on the level playing field. We all have an understanding of what cash flow is, and all are kind of working from that same spot. So this is the beginning. So I just wanted to kind of note that, so that if you're thinking, well, I'm already doing cash flow forecasting and this is already touching on what I know, that's why we're going to build off of this as a series. So let's just kick off our this here. Just have a few slides that I'm gonna throw up as we go through. And that's in the wrong spot. There we go. I hope at this point that you can see my screen and just don't use that. There we go. So let's start with defining some different types of cash flow forecasting that we can do. So we'll start with some definitions. Maybe I'll let you start it off.
Sure. No, that sounds good. So there's lots of terminology that is kind of being thrown around in industry, especially in marketing, advertising. I personally feel, Twyla can jump in here when she wants to stop me. It kind of muddles the waters a bit because people that aren't as familiar in the space, using similar terminology, like a very generic term like cash flow forecasting, really kind of confuses things. So one of the key differentiations that we like to do is short-term versus long-term. When Twyla was speaking about the services that we offer in our own accounting firm, 2080, we focus a lot on the short term. And that's kind of done by design in the sense that we do a lot of bookkeeping work and the short-term forecasting plays into that. And so short-term cash flow forecasting would be looking out 2 to 4 months, and it's looking at more of the daily ins and outs and how you can operationally help a company actually manage their cash position. So an example being, if a customer doesn't pay your client on time, does that affect their loan payments or their payroll or any other vendor payments? And it's very granular and time dependent. That's really been a key cornerstone of our actual service as an accounting firm. How does that differentiate or differ from long-term? Long-term, in our opinion, or maybe in my opinion, is a little more strategic or corporate planning kind of in nature. And so what I'm saying there is you're probably looking more at like a 2, 3, 4, or a 5-year forecast. And you're saying, okay, as a business or as an accountant talking to your client as a business, how can you improve your company? What are your goals? What are your revenue targets? What do you want to do at a high level? And what does that look like strategically and in the long run? And so really the key difference there is that you're probably looking at stuff on a month-end basis or a monthly basis as opposed to short-term, which is typically daily or weekly. Other terminology that we see is a 3-way forecast. And so a 3-way forecast would be when you have a profit and loss statement, a balance sheet, and an actual statement of cash flow. All of those 3 statements all tie together. And in doing so, it ensures that the actual forecast that you're making is accurate and reliable. And so you see that terminology thrown around quite a bit. And in my opinion, that really relates closely to long-term forecasting. So again, you're doing proper statements, you're forecasting those out, you're seeing what they look like, you present those to a bank. And so quite often, in my opinion, you can interchange long-term forecasting versus 3-way forecasting. You can certainly have 3-way forecasting in the short term. It's probably just not as important because you're typically more focused on the cash ins and outs as opposed to, overall statements tying together. Other terminology that you'll see is direct cash flow forecasting versus indirect cash flow forecasting. And so indirect cash flow forecasting is essentially where you're taking a profit and loss statement.
Yeah, your P&L.
Your P&L, and you're adjusting non-cash items off of that. And so what we kind of mean by that is depreciation. That's not actually a cash charge. It's simply an accounting estimate that's on the profit and loss statement. So in order to map out cash flows using your profit and loss statement, you actually have to add it back to your net profit. And so you have to keep doing that. You have to take your net income, keep adding or subtracting items to get to a cash flow number. And that sometimes it's called EBITDA. Sometimes people use that earnings before income, tax, and depreciation. They use that as a proxy. So you'd also be pulling things out like insurance accruals, prepaid accruals, items like that. Items that are just simply accounting estimates in the profit and loss statement. The direct method would actually be mapping out accounts receivable and accounts payable timing, and when people are actually pushing and pulling payments to you, and again, tying that into the overall cash flow forecast. Probably people would recognize that in a statement of cash flows. That's where you would really kind of see that. And I think that's probably, you can tell me if I described that good enough or not. Maybe I got a little too wordy there, but.
No, I think that sums it up in terms of the different types. And, the reason that we wanted to put this in here is because there is a lot of kind of dialogue that we see around what types of cash flow forecasting are we doing for our clients, and they all kind of serve different needs, and for the purposes of what we're going to talk about today, we're really going to hone in on the short-term cash flow forecasting. That's where we spend a lot of our time within our firm, is talking short-term cash flow forecasting. But I think it's just important to kind of set the stage, because there is different times that you have different needs based on different clients for the different types of forecasting. So let's carry on from there and dig a bit more into then next being who it is that needs cash flow forecasting. This is a question that we're often asked, is who do you do the cash flow forecasting for? And a lot of times when we discuss cash flow forecasting, we instantly think of the client who is running tight on cash, or who has missed a payment in the past. Somebody that is running really lean, maybe they're growing, maybe they're just starting, but that they don't necessarily always have enough cash, and you're really having to kind of keep your eye on that bank balance. That's usually who people think of when they think of the ideal client to create a cash flow forecast for. However, if I put words into Kelvin's mouth, he would tell you that everybody needs cash flow forecasting.
Everybody needs cash flow. They do. It's absolutely true.
It is true. Maybe explain why it's true.
I believe it's true because, we're starting up a software company. So using that as an example, maybe it's a bad one because it shows that we're in dire need of cash and you've got a runway and all that, but you need to plan it out. But using one of our own clients is a vet clinic. They're very stable, have income. They have a really good positive cash flow month over month, year over year. But what they want to know is, how much money should I have in my bank account, and what's the most efficient use of my capital, and how can I do all of that while still planning around, a X-ray machine purchase or an expansion on their existing facility, or should we be putting more money in terms of loans versus equity, all those kind of questions. So I find it super interesting because at every kind of cycle, in terms of overall business cycle, you've got, growth, mature, stable, and you've got decline. You certainly need cash flow forecasting, short or long term, in the growth phase, and you certainly need it in the decline phase until you're obviously bankrupt. But even in the mature phase, you still should have some component of pre-planning and foresight into your operations, because it simply it makes you more stable, profitable, efficient, and valuable. Because another viewpoint there is, if you're all of those things, your company's worth more to somebody that's purchasing you. So at the very least, even having that foresight and pre-planning as a company can get you more money even on exit. So all across the board, I'm a firm believer that you should have cash flow forecasting at all phases of the business cycle. People would be better off for it, for sure.
Yeah, no matter how much money they do or don't have, there's still value that you can add to your clients by providing them with a cash flow forecast. The other piece of who needs cash flow forecasting, and I was talking to somebody about this yesterday, so it kind of prompted this piece that I want to add here, is whether or not it's valuable to have cash flow forecasting for a client who doesn't carry any accounts receivable. And I think that that's a great question, because even between Kelvin and I within our own practice, all of our clients are our clients, but we still just divvy up, who really the main point of contact is, and
our niches, to throw other buzzwords out there.
Yeah, there's lots of buzzwords. We really just kind of look after very different types of clients. Kelvin's clients have got AR, and the AR managing the AR is a big chunk of their cash flow forecasting. And versus a lot of my clients are point of sale, or that they are or even like for example, a fitness franchise where the money that comes in is what comes in, there is no AR. So both of those examples, I think, are important to highlight that it's not necessarily around what type of business they are in terms of whether they carry AR or not that dictates cash flow. Because some of my clients who need cash flow the most in terms of, growing or managing cash are ones that don't have accounts receivable, and that they still need that piece to be able to see where are we going, what's happening, and where do I need to make sure that I'm not going to run into a shortfall or that I've got excess cash to do something else with.
And I think that's a good point, because there's even some clients that you have are more credit card heavy, even on the payment side. So it's not even just receivable, but it's also on the payment side. Because I know a lot of people that I've talked to in the past that said, well, my clients handle everything by their credit card, so I just need to know that one point in time and we're solid. I mean, but the reality is you I mean, that's a lot of your clients. They're point of sale heavy and credit card dependent on the payable side. But you're still cash flow forecasting for them to match essentially those two payments, or multiple to one. So it still can be applied across the range.
Yeah, you're absolutely right. I mean, the biggest part of a lot of my clients' expenses are things like rent and payroll, which are things that are very fixed and not things that you can really help them manage the cash in the short term per se. But there are things that, go onto their credit card or are automatically pulled, but there's still a need to actually manage their cash overall.
Yeah.
Okay, moving right along here. All right, so from that, now that we know types of cash flow forecasting, we know which clients need it, which we've said is
everybody.
Really all clients.
Calvin says everybody.
Calvin says everyone. Then let's start with the foundation of where you begin with cash flow forecasting. And really, in our minds, we believe this through and through, that the foundation is important, and the foundation is clean data. So clean data, we actually did a full webinar on the importance of clean data just a couple of months ago, I guess. And so with the recording link for this particular webinar, we'll also include the recording to that webinar. So if you really want to get nerdy, you can listen to both webinars. But that one, we get into more depth and more detail about how important it is, and kind of go through even our workflow, which I think I've included here in the next slide, within 2080, and how we use HubDoc in a lot of our cases, and that's what's kicking off the process in order to get clean data into the system.
And fully appreciate that HubDoc can be totally replaced with
Receipt Bank, auto entry. We've used Receipt Bank as well. This really is just the platform to kick off the start of clean data.
Yeah, totally. So did we want to talk about, is that my?
Yeah, that's you.
That's my cue. Let's talk about clean data more.
So get clean with data.
for clean data for us, I mean, we've got the workflow presented right now. We do things on a weekly basis, and we're actually trying to move to daily. But again, clean data for us is super important for the main premise of garbage in, garbage out. You can't do any kind of analysis or forecasting or anything coming out of an accounting system unless you have good quality data. And so it really does tie into garbage in, garbage out. And so that's why we focus on this as being the foundation, because without the good quality, clean data, your accounting system really doesn't become as effective, and any systems you tie into your accounting system after that are certainly not as effective either. It's a continual chain reaction. So without this first step, the rest is not as important or purposeful. So in order to get clean data, again, you can check out some of the other webinar material that we're going to be presenting, but the reality is this on another slide or not? Just for the terms.
Sorry. No, it's not.
Okay. So there's 3 terms that we like to tout, and that is consistent, complete, and accurate. And for us, that's what gets you clean data. And so in terms of consistency, it's using those auto OCR type automation tools on the front end, auto entry, Receipt Bank, those kinds of tools. It's really leveraging them as much as possible, excuse me, so that you can get consistent coding. And I always like to use the example of if you had, say, a telephone bill, and maybe you're recording that to the telephone expense account all the time. Sometimes if you do it manually, maybe that gets recorded to the utilities account, or maybe it gets recorded to something by mistake, like miscellaneous expenses. As soon as that happens, if you do miscoding consistently, it wrecks all your data in your system. And so any kind of forecasting or analysis coming out of an accounting system really relies heavily on variance reporting, exceptions, and anomalies. And so it's really hard to check anomalies if you have really inconsistent data. So the more consistent you can get it, the better. And so coding is key. If your telephone expense account is always being coded, or your telephone expense is always being coded to that expense account, it'll be super easy to pick out a variance in the actual amount, as opposed to trying to source out a variance due to a coding mistake. So consistency is key. I mean, these automation tools are super great for helping with that. Leverage them as much as you possibly can. It totally helps out with forecasting. Then we have the term of completeness. And so completeness to us is ensuring that all data is there. And so, there's two concepts: accrual accounting and cash accounting. Accrual accounting is a really good example because you might have done work for an invoice, or done work for a job and created an invoice for it, but not have actually been paid. That information is quote unquote complete based off your actual invoicing. Whereas when you cash code, you're going to have to know that that work was actually done. So you're going to have a little bit more intimate knowledge of the company or your client, or how they work, or dialogue with them more, in order to get completeness. And so you can do either way. Cash coding is totally acceptable and awesome. So as accrual accounting, obviously. The point is that you just need complete information of what is happening with the business in order to know what's going to probably continue into the future. And so completeness is also kind of a core pillar of our foundation. And so always knowing what's going on is probably the best way to say it. So complete information about the situation probably means you're going to have to dialogue with your client a lot more than you maybe have in the past, but that's actually a good thing because it really strengthens that relationship with your client and actually gets you more information that can help you in other areas. That's kind of what we have found.
For sure.
Last concept would be accuracy. And so accuracy is pretty simple in terms of, if I have this bill and it's for $100, does it have the right date, the right amount, the right GST? Is it coded to the right account? Is it accurate? Is that actual piece of information accurate? Kind of a sub-concept within here is actually timing, though, because you can have the concept again of cash versus accrual. And so there is a timing component there where you can also, or you do also need accuracy in terms of the timing and the inflows and outflows. If you're doing accrual accounting, that becomes much more important in terms of accuracy.
Yeah, no, I think that's great. And I think that, when you're starting to build out a cash flow forecast, instantly what you kind of end up using two different pieces. You use what's happened in the past, and then the intel that you've got about the client in terms of what's going to happen in the future. And I know for us, for a number of years, we've done some very simplistic cash flow forecasting for some clients, where it is just looking at the past and seeing what's been going on, and then modeling that out for the coming months. And so if there isn't consistency in the data, or there's not the right timing in terms of like a cell phone bill or a phone bill every month, it just makes it a harder starting point to build out what's going forward. Yeah. So we always suggest that this is the starting place, that when you're looking at bringing in cash flow forecasting and starting that for a client, is think about the accounting system. How clean is that data? Do you have that foundation in place to build off of to then create a cash flow forecast? And if not yet, what can you do to get to a spot where you've got clean data so that you've got that spot to build from?
Yeah. And I think that's an interesting point too, because you're also getting to, if your foundation's really good, it actually takes a lot less time to then do the forecast as well. Like, a lot of people think of forecasting in general, not just cash flow forecasting, as this ubiquitous item that's going to take a ton of time and effort, and how can I charge for it appropriately? When the reality is, if you have the core foundation there, it can be very simple, and not very simple, but easier. Yes. And much less complicated than it needs to be. Again, if your data is clean, it's not as hard as it needs to be.
Yeah, you just have a more efficient starting point, or more efficient, your process will be more efficient if you've got that clean data and that foundation to start with.
For sure.
So, okay, let's just flip to 2 here. All right, so now that we know we've got that starting point, that clean data foundation, then the question that we get asked the most is, where the heck do I start from there? So I've got the clean data, I'm using all the systems on the front end of my accounting system, I'm reconciling within my accounting system on a regular basis. Now where do I start? So I think again, it goes back to identifying what are the needs of your client and figuring out which of the types of cash flow forecast it's going to make the most sense to create for them. And then, we always suggest that you actually start with a spreadsheet. And I was sharing this with somebody else, saying that we're mean in our firm here. We don't let somebody use the apps and the tools that are available until they've at least done a cash flow forecast within the spreadsheet. And from my experience, that just really prompts you to get very granular and detailed with the ins and outs of a client. So I'm not suggesting that you want to do a spreadsheet for every single client. If you're wanting to roll this out to all your clients, believe us, we know that is not efficient and not scalable very quickly. But it is a great starting point if you've never ever attempted a cash flow forecast, because it does force you to line by line say, what do I expect to see come in? What do I expect to see go out over the course of a month? And depending on the type of business, you might be able to take that 1 month and then duplicate it in chunks to now you've got 90 days. And so you use that as your starting point of your framework to build out your cash flow forecast. So that's something that we used Excel here in our firm for quite some time.
Years.
Longer than we would like to admit, to be honest. And
no, we'll admit it was years. Come on.
It was a long time, considering how inefficient, spreadsheets are inefficient. Spreadsheets are prone to error. I have put it in myself that you put something that's a negative versus a positive, and you look at it and you think, that's not right. They're not supposed to have that much money. And it's because you flipped a number around. And it quickly gets outdated. If you've got a client then who turns around and makes a payment the very day that you created that Excel spreadsheet, a payment that you weren't anticipating coming through because it was something that's off of the accounting records, then instantly it's outdated. And so I don't necessarily suggest that for growing this part of your practice, but I do suggest it just as a starting point to get super familiar with the process of cash flow forecasting.
Yep. And I think to really kind of tie that in, starting with your own firm or practice or a client that you know really well, I think in doing it with a spreadsheet or even on paper, whatever that looks like, a more manual process, because you know that business so much better, you're going to know at a high level those ins and outs and what does look right and what doesn't look right. And to kind of speak what you're saying to, you will be able to see what did I do wrong in that spreadsheet? Mm-hmm. And then you'll be able to change it, manipulate it, make it right, and make it accurate based off your expectations, which then will give you the appreciation for how hard or easy cash flow forecasting can be.
Yep, absolutely. I mean, the thing with using an app for a cash flow forecasting tool is you still want to have some comfort that the app is predicting what you expected it to predict. And that's what I do like about a spreadsheet, is that, again, you get to know the client even better than you probably already did. But then you can see very clearly, and this is something that's always important for me with my clients, is I want to know if it's going to go to a negative or jumps to a positive that I wasn't anticipating. What made it do that? What made the cash go into that spot? And so within the spreadsheet, you can easily tell, you see the running balance. You can easily tell, okay, here it is. Here's where the pivotal spot is. And at this point, then they go into a spot that they don't want to be in, or vice versa. At this point, when they collect that big AR, now they've got into a cash position that sits much, much better than the beginning part of the month, for example. So the other thing that we always suggest is start with your own firm. And I would be willing to bet that, even some of you who responded to the little questionnaire when you're registering for this, you said, no, I don't do cash flow forecasting. You probably do it for your own firm, or even yourself personally, to manage your own finances or your own bank account in a way that it's like, okay, am I going to have enough money in there to cover off the money that's going to get pulled from that account? And so nobody knows your firm numbers the way that you do. You can probably recite them off the back of your hand. Timing, when money's coming in, when money's going out, the typical time of the month that you tend to have lower money coming in or lower money or higher money in your account. And so that's a great spot to start, is to start with those numbers that you know so well. And then from there, the next spot that I suggest that that you go to is a very simple client. So even on one of the recent posts that we had put onto the Facebook group, we asked, what's the challenges that you have with cash flow forecasting? And there was a lot of
lines of credit,
prepaids,
accrual items.
Yes, things that aren't as simplistic. And so as we build on this webinar series, we will touch on some of those more complex considerations that you need to deal with when it comes to dealing with cash flow forecasting. But that's probably not the client to start with. The client to start with would be one that's a bit more straightforward, and also one that you just know inside and out. So somebody that you've been working with for at least a period of time, that you know what you're expecting to see ins and outs on their cash flow forecast.
Yep. Yeah. And again, simply just to get a feel for the framework of what cash flow forecasting could look like, because you might actually have one of your more complex clients being the one you actually know best, but you need to know the framework of the actual cash flow forecast first before you can then apply it to those more complex cases, because the ins and outs just become more variable and complex.
Yeah, for sure. And the simplistic example that you set with firstly your firm, and then with your client that is a bit more basic, will again then lay the understanding and the foundation towards building out cash flow forecasting for those clients who do have things like prepaids or lines of credit or a ton of seasonality, or a lot of cost of goods sold that's very much hinged on revenue, that sort of thing. There's endless complexities that we can have with our clients that need to go into the cash flow forecasting, but that's not where we would suggest that you start when you're starting to get into this area of forecasting. Yep. Just to kind of give you an example, as I see now, this is quite blurry, so my apologies. This is a basic Excel spreadsheet. I've shared this with people in the past because there's nothing crazy in here. This is literally, you start with your opening bank balance, and day by day, line by line, what money is coming in, what money is going out. So when I build one of these, I start with today's bank balances being your top line. Then what I do is I usually do an export from the accounting system of your AP and plunk that in, and then manipulate that according to when I anticipate that to be paid. Sometimes you can work off of due dates and sometimes you don't. And then I plunk in, same thing, I export out of the accounting system, the AR listing, put that in, when do we expect to receive those payments? And then I start to build in what other things go in and out of the bank account that are not part of the AP and AR, but that are monthly transactions. That's how I start this. How would you say that you start it? Because I've never actually watched you build out one of these versus how I.
No, I actually do it the exact same way. It's just for some of my clients that have more accounts receivable for the future looking items, I'll start building in more complexities like timing around general accounts receivables. So with a spreadsheet, I can never build it out quick enough to have individual future looking accounts receivable items. So stuff that has not actually happened. Mm-hmm. So I start to get a little more kind of high level on that, but still put some functionality around that. But it still looks exactly the same as this. It's essentially just a time series and cash flows, ins and outs.
Yeah. Yeah. And I mean, this is where that clean data comes into play, because once you've got your AR and your AP in there, then usually what I will do is I'll look back to see, okay, when have they paid their phone bill? When have they paid their payroll, their rent, their everything that you typically see come out of their account specifically? When does that come out? And then I start to use some best guessing as to what they're going to have for revenue. That then prompts a conversation with the client to say, what do you anticipate having for revenue? Because they know those numbers better than I do if we haven't had that recent dialogue. But I at least build it out to say, if we've got, an average that continues for the next few months, that's an average of the last few months, then I start to build that in, and getting as granular in terms of the timing of that receiving of the the revenue as I want to. Again, I talked earlier that I have point of sale clients. And so with those clients, I tend to use weekly. And on Fridays, I say whatever's coming in this week is coming in, has come in. And that on Friday, I expect this weekly amount to come in on Friday. But you can go daily. You could do this monthly if that's your workflow, whatever that looks like. But this is kind of a starting point that we used this for quite some time, and definitely it worked. With your running total along the side, you can see when it's going to dip into a negative number, and you need to have sometimes tough conversations with some clients.
Yeah, for sure. I think we can also probably throw that up on show notes.
Yeah, totally. We could definitely do that. There's no tricks in there. I tell you, that's really a basic spreadsheet. But I have given this out to a number of people in the past, and it's certainly something I don't mind sharing if you want to use our framework as the start of your framework.
It's a very simplistic framework.
It's a very simplistic framework. That's not the complex example by any stretch. All right, so we're already stepping into some question time, which I'm just going to stop sharing because I can see that a few questions have come in here. That give me just a moment. I just want to scan through a couple of these to answer some of these. The first question here is, with short-term cash flow, how often do you check in with your clients to keep them on track? I've got my own answer. I'm gonna let you answer and then I'll answer. We'll see if we're the same.
I would say it depends. My typical framework is weekly because that's how we structured our firm. We do the bookkeeping weekly for most clients. But there are certain times where our clients need, or my clients need, more help than others, and whether that's because they're in dire need or because they just simply need more management and strategic planning around that time, it can literally turn into every single day of that week. Going through recession here in Calgary 2-ish years ago or more now. Time's flying. Yeah, or still, fair enough. There were certain times where I'd be talking to people about their cash flow for literally 2 or 3 times a day. And those decisions would be happening on a daily basis where it's like, well, if we structure this financing this way and we get these loans coming in and we collect these receivables, then we can pay this. But if we don't, then what do we pay and what does that look like? And then you'd have to compute it, calculate it, and come back with a different answer. So very frequent and high touch. At a bare minimum, I like to do things weekly. And that's even for companies that are very good and stable because, again, the way that we've set up our practice is that's part of our service offering is we manage people's cash for them. I feel like they love us for it because nobody's ever said, please don't do that for me. We make their lives really easy. And part of that is forecasting the cash flow on a weekly basis and then starting to handle their payments through things like Pluto or Bill.com or Veeam, whatever that looks like. And so at a bare minimum, I speak with my clients weekly, but even that weekly kind of turns into probably like twice a week. There's always something that happens midweek where the client now just expects or knows, hey, I know this is going to impact cash flow, so I should just give Kelvin the heads up that this is going to happen so they can model it out.
Yeah, no, that's a
so what's your answer? No.
Well, my short answer was it depends, but I think really, something that I think we should always consider is what is your workflow? And so, if your workflow with your clients is monthly, not weekly, then it might not make sense to update your cash flow weekly. I mean, our
Absolutely.
process here internally is on a weekly basis. Everything from HubDoc is pushed over to the accounting system. The accounting system's fully reconciled, and then we start to look at cash flow. And so without reconciling the accounting system, I'm not saying you can't do cash flow because you can, but you may be missing something or you may be doing more work than you need to be doing because if it was reconciled, it's just going to kind of pick some of those items up. And so I would suggest that really depends not just on your client's needs and where they're at in terms of cash needs, but also what your workflow is. And so if you are updating everything for the client monthly, there's probably not much value in doing this more frequently than monthly because it will be time consuming to do it that frequently. So I like to suggest that you align your cash flow forecasting with your workflow. Doesn't mean that you don't check in though with your clients. I think part of that question is how often should you check in with your clients to keep them on track. Doesn't mean you can't check in more than monthly, but if they're in a cash crunch situation, which believe me, I know what that's like to deal with a client that it's tight cash, and it becomes more than once a week for sure. And on a week where there's payroll and rent coming out, and again, they're point of sale, so you can't necessarily predict what's coming in when. Then cash flow in those cases gets done more than once a week.
For sure.
So not necessarily ideal, and that's not the spot that you want your client to be in long term, but that can be real life for some clients. And so there's a lot of dialogue with those clients when they're in a tight cash spot.
Yep.
Yeah.
Even, to go on your point there, you can even have a quarterly cycle in theory.
Totally.
And I think that's a great point. Like we should actually revise our little clean data section and put reconciliation in there, because that is a huge point. If your system isn't up to speed when you do the forecast, it creates a lot of issues in terms of the completeness and your vision of what's moving forward. And so, getting a little off topic there, but what I was going to say is if you're on a monthly workflow, you could probably talk to the client 2 times in the month, right? And still get away with it. So create your forecast, look forward, touch point with them maybe mid-month and say, how are things going? Are you trending in the right direction or not? And why or why not?
Yeah.
And then use that information to then start or help with the next future revision of your forecast.
Yeah, no, for sure. No, that was a great question. Let's see what else we have here.
Thank you for the comments.
Yeah, I know, this is awesome. So I think we've had a few people ask about the spreadsheet, and yeah, we can definitely shoot that out. I can attach that even to the email that you guys get following this.
And I think one thing to point out there is if there's any questions around even how to utilize that spreadsheet within an actual scenario, like feel free to shoot us questions back.
Yeah, that's a super great point.
And if people are open to talking about it on the Facebook group, that would be an awesome point or place to put it out there, because then that, we could anonymize the data so that it's not an actual client situation. But, we're here to help everybody and kind of further the industry in this space. And so solving other people's pain points in those questions and presenting that to the group could actually be quite beneficial for other people.
Yeah, no, for sure. I mean, actually, I've been on a Zoom chat with somebody literally setting up that exact spreadsheet. They had my template and we're trying to plunk in everything from their accounting system and build it out for their client. And we went on to a Zoom chat and she did a screen share and we just walked through it. And if that's of value to somebody, yeah, for sure, let us know.
Yeah, for sure.
So yeah, we will shoot that out. What else have we got here for questions? We will also send out the recording. I see that somebody maybe missed that from the beginning, but we will indeed send out the recording later.
Yeah, as well as the flow chart.
Yes, yeah, we can attach that as well. Yep, the workflow chart, yeah. As you'll learn, if you don't already know Calvin and I, we are an open book. There's not much that we won't tell you, because
nothing's a secret.
It's absolutely right. And there's one thing that we love about the accounting community is how open everybody is to sharing, because everybody can benefit from hearing what other people are up to. Pick and choose from what people are doing that's going to work within your practice and what you've designed within your firm. But yeah, for sure, if there's ever any questions around kind of what we've done, make sure that you let us know.
Yeah. And I think that's good to point out because, ultimately there's a lot of maybe negativity associated with terms like advisory and cash flow services and stuff like that. And the reality is, we're all just accountants, bookkeepers, and consultants and business coaches that are just trying to help our clients. And the reality is there's no one good term for everything. And really what we're just trying to do is help everybody help their clients. And so if we can help somebody else out, there's already been a few comments that people have made in the Facebook group where we've taken that back and said, that's an amazing idea. And how can we integrate that even within some of the stuff that we're doing? Mm-hmm. By helping other people, we'll help ourselves.
Yeah, for sure. It's all about the community. Somebody's asked where you could find that Facebook community. So the Facebook community, I could even put a link to that in the email. It's just called the Helm Yeah Community. So Helm space Yeah Community. And really that's intended to be an extension of this type of dialogue. So what are people experiencing with cash flow? How are you doing your cash flow? What are you doing in terms of pricing or cash flow, whatever, anything related to cash flow is what we want to have included in that community. It is something that, other people can post on, everyone can respond to. It's really just, again, an extension of this, that it's about sharing. So yeah, I can put that in there as well.
And I think to expand on that, it's not just short-term cash flow forecasting there. Like that's really we're really good at that. I'm not saying that we're not good at other stuff. That kind of sounds bad. But we've already had people ask about longer-term forecasting things in there too.
Yeah,
so
for sure.
I mean, it's a good community for anything related to forecasting, I feel like.
Yep, for sure. I think we've covered off most of the questions here. Somebody did ask about, is Helm available in QBO?
Not
and
yet. Shame,
believe
for
me,
shame, I know.
Everybody in this office hates me because I'm always wanting to talk about when that's going to be done. But it is in the works, and we do anticipate that to be launched here later this year. So that's that. The other thing I wanted to mention is that we would love to have people's feedback in terms of what they would like to have us discuss in future webinars. We plan on bringing some guests in and having them share a little bit about some of their cash flow experiences. I do think, without going too far, getting too far ahead of ourselves, I do think that part of the next question or the next webinar will be having dialogue with our conversations around cash flow, because even for me, when I use a tool, or even when I look at the spreadsheet and I look at it and I see that it's going to be good or bad or otherwise, it's a case of, well, now what do I say to the client? What does the client need to know? What's top of mind for them? And sometimes those conversations might be not what your client is used to hearing from you about. And
they
so
probably won't like it.
There's some difficult conversations. In fact, that had been brought up on the Facebook group already, was, about having some difficult conversations with clients, and maybe sometimes our clients don't like us for bringing some of this up. I always think about what if you don't bring it up? And so we will probably in our next one talk a bit about what cash flow conversations look like with a client, whether you are just starting to demonstrate to them that you can offer this as a service, or you're already offering it as a service, and having some conversations around what can we do, what action items are there that we can take if money looks like it's going to be in a good or bad spot in the coming weeks and coming months. So I think that's probably where we'll take the next one, but we would absolutely love your feedback around what you would like us to talk about, because ultimately we want this to be something that you guys are interested in, and that is useful and valuable to the community. As we said, we'll share as much as we possibly can, but it'd be helpful to know what else you want to hear about. So
yeah, for sure.
Perfect. I think we've covered off all the questions, so we'll probably wrap it up there. If anyone's got anything else, feel free to quickly shoot it through now, but I think we've caught everything. I see somebody, Tammy had commented on seasonally doing cash flow forecasting, which it can be a great way to look at it, because if you've got a very seasonal client that's got some trends throughout the year, then that can impact timing as to, okay, when is cash flow most important? And maybe there's like 6 months of the year that you need to do cash flow on a weekly basis, and the other 6 months of the year it's not as a key piece to do every week. It really is unique to that client. So, perfect. I think we've covered everything off. So I just want to say thank you guys for joining us. This is awesome. I mean, we were told that probably about 25% of the people who signed up would be here, and there's way more than that. So awesome. We just love this. We are so pleased that you joined us today. We hope that you'll join us next time too. If you have any questions, and if you have any questions for us, you'll have our contact information in the email that you get. Reach out to us on social, Helm_Kelvin. Right? And
I don't even know.
Helm _ Twyla. Yeah, I'm pretty sure that's it. So
that's terrible.
I'm pretty sure that's it.
Okay.
Helm and then _Kelvin, Helm _ Twyla. So or Twyla at takethehelm.app, Kelvin at takethehelm.app. So if you've got any questions, you guys, please let us know. We wanna help and contribute back to your process. So we'll leave it. Yep.
Yeah, and if there's people that want to contribute to blog post community, whatever, like
Yeah,
I think we're totally open to that. So whatever.
Yeah, for sure. We want to get some other people's ideas on what you're doing for cash flow advisory. That's often one of the questions that we do get asked, and we will touch on that later, is how to price for this. So we'll wrap in a few of those ideas, but yeah, anything you've got that we can share, let us know. Thanks, guys.
Thank you.
See you next time.